If you own an S corporation, one of the biggest questions is how much salary should I pay myself? Pay yourself too much and you may be giving up tax savings. Pay yourself too little and you may be creating an IRS problem. And unfortunately, a lot of business owners are either guessing, copying someone else what they told them, or avoiding payroll altogether. So in this video, I want to explain why your S Corp salary matters, how it affects your tax savings, and why this is something you should review every year, especially if your business income has changed. Before we get into it, make sure to like this video, subscribe to the channel, and download my 5-step year-round planning checklist using the link in the description below. It will help you stay on track so you can keep more of what you earn. The main reason many business owners choose to be taxed as an S Corp is to potentially reduce self-employment tax. With a sole proprietorship or a single member LLC, your business profit is generally subject to what's called self-employment tax. But with an S Corp, the owner generally takes money out in two ways. First, through a reasonable compensation, which is salary paid through payroll. Second, is through distributions, which are generally not subject to Social Security and Medicare tax. That is where the tax savings can come from. But here's the key point. You cannot simply take all the money as distributions and avoid payroll tax. The IRS expects the S Corp owner who works in the business to pay themselves a reasonable salary. So the issue is not whether you can take a distribution. The issue is whether your salary is reasonable based on the facts and circumstances of your business. One of the biggest mistakes I see is that business owners hear an S Corp saves taxes. They assume the goal is to pay themselves the lowest salary possible, but that is not the right way to look at it. The real goal is to create a tax-efficient structure that still makes sense and is defensible. So for example, if your business makes $150,000 in profit before your owner's compensation, and you pay yourself a salary of $10,000, that would most likely raise questions by the IRS. On the other hand, if you pay yourself the full $150,000 as salary, then you may not be getting much benefit from your S corporation at all. So there's a balance. The balance is where planning comes in. A reasonable salary is not just a random number. It should be reviewed based on things like what services you provide to the business, how much time you spend in the business, your roles and responsibilities, the type of business, the amount of profit, and what someone else might be paid to do the similar work that you do, and the relationship between salary and distribution. The last point is important. The IRS can look at whether the salary seems too low compared to the distributions being taken out of the business. So if you're taking a large distribution but very little salary, that can definitely create some risk. Another mistake is treating the S Corp salary as something you get to set once and forget it. That is not how I would approach it. Your salary should be reviewed every year. Why? Because your business changes. Your profit may go up, it may go down, your role may change, you may hire employees, you may work fewer hours, you may add retirement planning, and you may start paying health insurance through the business. All of these things can affect the planning. For example, if your business income grows significantly, the salary that made sense last year may not make sense this year. Or if your income drops, maybe the salary needs to be revisited so you are not overpaying payroll taxes unnecessarily. This is why I believe S Corp planning should be part of year-round planning, not just something discussed when the tax return is being prepared. By the time the return is done, the year is already over, and you want to make sure that you make these decisions during the year while there is still time to adjust. Another major issue is payroll compliance. If you are an S Corp owner and you actively are working in the business, you generally should not just take owner draws all year round and ignore payroll. You need to actually run payroll with payroll taxes withheld and paid. This means filing payroll tax returns, making payroll deposits, and reporting your wages correctly. Some business owners take take distributions all year and then try to clean this up at the end of the year. Sometimes that can be addressed with year-end payroll planning depending on the situation, but it is much better to plan throughout the year. At a minimum, S Corp owners should be asking, am I running payroll? Am I paying myself a reasonable salary? Are my distributions being tracked properly? Do my books clearly separate wages, distributions, reimbursements, and business expenses? Have I reviewed my salary and compared this to the business profit? If the answers to those questions is unclear, then the S Corp may not be working as well as you may think it is. Now, let's talk about the tax saving side. The lower your salary is, the more potential payroll tax savings you create. But again, that does not mean the lowest salary is automatically the best. You have to balance the tax savings with the reasonableness and compliance. Also, salary affects other planning areas. For example, your salary may affect retirement plan contributions. It may affect how health insurance is handled. It may affect payroll taxes. It may affect your QBI deduction planning. And it may affect how much money you are taking from the business as distributions. So when I review S Corp salary planning, I do not look at salary in isolation. I look at it as part of the full picture. The question is not how low can I make the salary? The better question is what salary gives us strong tax savings while still being reasonable and supporting the rest of the tax plan? That is a type of question business owners should be asking. So let's use a simple example. Suppose your S Corp has $120,000 of profit before paying you. If you pay yourself the full $120,000 as salary, there may be little or no S Corp payroll tax savings. If you pay yourself nothing and take $120,000 in distribution, that's likely going to cause a problem. But maybe after reviewing the facts, your business type, your duties, the profit level, a salary somewhere in the middle may make sense. The exact number depends on the facts. That is why I do not like using a one-size-fits-all answer. Some people say just pay around 50%. Others say use an industry salary database. Those may be helpful reference points, but they are not the whole analysis. You need to consider your specific situation. The salary for a consultant, real estate agent, online business owner, contractor, or professional service provider may not all be the same. That is why this needs to be reviewed thoughtfully. So when should you review your S Corp salary? I would review it at least once per year, but there are a few times when it becomes especially important. If your business profit has changed significantly, if you recently elected the S Corp status, if you are taking large distributions, if you have not been running payroll, if you are planning retirement contributions or paying health insurance through the business, or it's getting close to year end and you haven't reviewed it yet, or your tax bill is expected to be much higher than last year. These are all signs that your S Corp salary should be reviewed. So here's the bottom line. An S Corp can be a powerful tax saving structure, but it only works if it is handled correctly. Your salary should not be a guess. It should not be ignored, and it should not be based on trying to pay the least amount of payroll tax possible. The goal is to pay yourself a reasonable salary, preserve the tax savings where possible, and avoid creating unnecessary IRS risk. If you are an S Corp owner and you are not sure whether your salary is reasonable or whether your S Corp is actually saving you money, this is exactly the type of issue that should be reviewed as part of your year-round tax planning. You can see in the link down below a link to the 5-step year-round tax planning checklist that'll include things such as reviewing your S Corp salary. And if you want help reviewing your S Corp salary, tax savings, and overall tax planning strategy, click on the link down below and book a planning call. Thanks for watching, and make sure to like this video and subscribe for more tax planning strategies for small business owners. I'll catch you on the next one.